maybe just starting at a really high level, we were talking a little bit beforehand about a little bit of confusion in trying to get a sense of where the Fed is really at. And so I'd love to get your opinion on just where their headspace is at the current moment. But maybe could you give, for listeners who might have missed it, just a summary of this FOMC, what were sort of the salient points, and then we can get into the context around it.
Yeah, well, I think, there's basically two important points, I think, that I took away from the FOMC meeting from a policy standpoint. The first was at least an acknowledgement in the statement that the progress towards getting inflation back to their mandate has stalled, which I think is a very conservative way of recognizing that the data over the course of the last couple of months has certainly, at a minimum, been inconsistent with getting more confidence, and probably indicating that inflation may be moving in the wrong direction relative to their mandate. And then I think the second matter, of course, they kept interest rates constant because that's what everyone expected, and they largely just adhered to the basic expectations that coming into the meeting. But the main policy change was tapering the QT, the pace of QT, which is a little confusing mismatch of directional words, which basically means right now they're letting the balance sheet roll off for treasury bonds at about $60 billion a month in terms of what's maturing, and they're going to slow that and only allow about $25 billion to roll off a month. And so there was some expectation that they were going to slow the pace of quantitative tightening. But on the margin, I'd say this was, probably the median expectation was about 30, that they were going to go from 60 to 30. And here they announced going from 60 to 25. So, a little more dovish than, very marginally more dovish than what people expected from a policy standpoint. So that's the basic announcements. I'd say in terms of a take, it's kind of an interesting combination of things. Most people expected some sort of shift in quantitative tightening to slow that pace coming into this meeting, either this meeting or the next one. So that wasn't much of a surprise, but it is pretty weird for the Fed to basically say, we're going to engage in an easing action by slowing the pace of QT. At the same time, they're basically ramping up their rhetoric to highlight the fact that they're getting further away from their inflation mandate. And so those two things, easing while becoming farther away from your inflation goals, is at best a bit inconsistent and at worst probably imprudent in terms of a policy mix that we're seeing.
So, Bob, what do you think is driving that policy mix? I mean, we're going to talk about the QRA as well, and there's been an enormous amount of focus on the Treasury and fiscal writ large. But what do you think is driving this particularly sort of confusing move?
Well, I think there are folks in the Fed who are at least making the case related to the balance sheet that engaging in quantitative easing, which is the outright purchase of longer dated Treasury bonds, is functionally an easing in the markets, and you can imagine why. Which is basically when you buy Treasury bonds, it both depresses the yield on those bonds, which is stimulative, and also provides more money that gets injected into the financial economy. And so there's folks in the Fed who argue that is an easing, buying bonds is an easing, but at the same time argue that that letting the balance sheet roll down is not a tightening. And so from that stance, the officials, and to be frank with you, that doesn't make a lot of sense to me, because to the extent that bonds are maturing, long-dated bonds are maturing on their balance sheet and then are not repurchased by the Fed to keep their balance sheet constant, it means someone in the private sector has to buy those bonds, which means that they have to trade at a higher yield or a lower price in order for someone to be incentivized to go buy those bonds when they get reissued. So that doesn't make sense. But the Fed eggheads really think that that's how monetary policy works. Frankly, without a lot of empirical evidence or common sense evidence to support their case. And so, from the Fed's perspective, slowing the pace of QT is effectively, they're viewing it as not a monetary policy activity, even though I think it is. And what they're really worried about with quantitative tightening is that by rolling down the balance sheet, they're reducing the amount of liquidity in the system, And I'm sure folks who listen to this on a regular basis are often hear about various measures of liquidity in the system, particularly the RRP, which gives some indication of excess liquidity or excess reserves in the system, where there's some indication that if quantitative tightening rolls off, then that RRP will fall over time, which would then create less excess liquidity in the system, initially in the RRP, and then eventually, as quantitative tightening, as it keeps going, would eventually start to create a fall in bank reserves. And Chairman Powell, acknowledged very specifically in the meeting, in the presser, how he's very concerned about what happened in the 2018 period, where there was a liquidity problem and wasn't enough reserves in the system for the banks, which created a spike in repo and other short rate markets. So they're very, very concerned about that. So from their perspective, you're getting in their head, they see slowing QT as having no monetary impact, no monetary policy impact, and is helping deal with that liquidity problem that could exist were it to continue at its current pace.